Welcome back to Foresight Bureau. In this video, I'm going to share a hypothesis that might explain why the Fed chose not to reduce interest rates this month, even though many believe it would have been the logical move. Before we begin, here's a quick word from Simon, who is my human puppet master. He's the person who writes the scripts that I narrate for his videos.
Hi guys, just a quick one to say I am a real human. I just use AI voiceovers and editing tools because it just makes my life a lot easier. Some of you have said that you prefer a human voiceover. I'm going to continue with this format for now, but I just wanted to check in and say, yes, I am very definitely human, and so is my team.
Thanks, Simon. Let's now get on with the video. The general consensus among a growing number of financial analysts is that the Fed is misinformed at best, or completely incompetent at worst. Critics like George Gammon, Jeff Snyder, and Steve Van Meter are some of the most vocal critics. They claim that Jerome Powell is out of touch and indecisive, and accuse him of lacking conviction as he keeps insisting that more data is needed before he is prepared to change Fed policy. This expert teaches finance at the Wharton School of Business and is the chief economist at Wisdom Tree, and even he doesn't understand what's going on at the Fed.
I'm calling for a 75 basis point emergency cut in the Fed funds rate, with another 75 basis point cut indicated for next month at the September meeting. And that's minimum. The Fed funds rate right now should be somewhere between 3.5% and 4%. Let me give you very simple logic of my position here. At the June meeting, the Fed has said that the long run Fed funds rate, when inflation reached 2% and unemployment has come up to 4.2%, should be 2.8. That's the normal. 2.8 is the normal Fed funds rate. Well, on Friday, we blew it across the employment number. We're at 4.3. That even argues for a lower one. Now, as far as inflation, we're at 2.5%. We've gone down 90% towards the target on the inflation rate. We've overshot the target on the employment. Those are the two targets explicitly mentioned by the Federal Reserve. All right, and how much have we moved the Fed funds rate? Zero. That makes absolutely no sense whatsoever.
However, I believe there is a deliberate and coordinated strategy at play, where keeping interest rates high is intended to serve a greater geopolitical purpose, even if it risks damaging the U.S. economy and triggering a global recession. If we examine recent developments through a geopolitical lens rather than just through finance and economics, it all starts to make a lot more sense. Let me explain. But before I do, the situation is developing very quickly. On Monday, the 5th of August, markets were down sharply, and the fear index approached record highs not seen since the pandemic. As a result, chances of an emergency rate cut have increased. However, even if there's an emergency cut, I'm going to stand my ground and predict that the Fed will only cut rates by a maximum of 0.5% in 2024. All those clamoring for a rapid series of rate cuts this year will be sorely disappointed. The reason I'm so convinced is that I believe there's more happening behind the scenes than is immediately apparent, leading me to a conclusion I call the swarming defense hypothesis. This idea draws inspiration from the defensive strategies of bees, which I'll use as a metaphor to help explain what, in my opinion, might be going on behind the scenes. In short, I believe there's sufficient evidence that points to a coordinated attempt by the Fed and the Treasury Department to weaponize the US dollar and collaborate with allies to wage economic warfare against China, Russia, and its partners. I'll explain why these actions, though painful in the short term, might be deemed necessary to avert a larger catastrophe in the form of potential military conflict. Let's start by understanding the metaphor. When a hive of Japanese honeybees is attacked by giant hornets, they swarm around them and vibrate. This selfless act generates enough heat that the invading hornets are slowly cooked to death.
The scout has information to share. Using an advanced form of chemical communication, the scout passes on details of the exact location of the honeybee's nest. The hornets do sometimes eat the bees themselves, but they are more interested in the protein-rich larvae inside. Individual bees have no chance against the hornets. Gradually, they weaken the bees' defense. There are many casualties. But it will take more than this to overcome the colony. The bees prepare to fight back. The counterattack is started by a handful of worker bees. It appears suicidal, but the bees are programmed to lay down their lives for the survival of the colony. And the tables begin to turn. Bee stings can't kill the hornets, but they do weaken them. As the bees gain the upper hand, pushing their attackers back, they now release the full force of their defense for the last remaining hornet. They swarm, immobilizing it. The bees vibrate, raising the temperature at the center to a level the hornet cannot withstand. And the hornet is cooked alive.
Although physically taxing for the bees, and in some cases deadly if they get stung, the collective action taken by the colony ensures the hive is protected from potential destruction. Ironically, Western honeybees do not have the same defense mechanism, so would be easily defeated. Translating this to monetary policy, imagine the hornet as geopolitical threats posed by adversarial nations. In response to rising tensions around the world, the Federal Reserve, much like the bees, is prepared to maintain higher interest rates for longer and expect the nation to collectively endure short-term economic pain in order to cook the economies of adversaries by crushing their currencies and disrupting their ability to trade so that they eventually can't function and therefore can no longer pose a threat. But this strategy isn't just about America. It's part of a larger, coordinated effort among Western nations and their global allies. Wars are incredibly expensive endeavors, requiring vast amounts of financial resources to cover the costs of military hardware, technology, logistics, and personnel. For instance, modern military hardware such as fighter jets, tanks, and precision-guided missiles cost millions of dollars each. Training and maintaining a military force capable of large-scale operations also requires continuous investment. Additionally, sustaining long supply chains and securing essential imports like energy and food during a conflict can drain a nation's economy. So strategically weakening the economies of China and Russia through sustained high interest rates, trade restrictions, and sanctions makes perfect sense. To back up my hypothesis, let's consider China's current situation. Although there's no doubt that the Chinese government is to blame for many of their internal struggles. Examples include growing unemployment, homelessness, and rising household debt, which are a direct result of the recent real estate slump. However, there are some signs that indicate that Western economic interventions are starting to have the desired effect. I believe that the rapid decline of investment and total consumption has been in part caused by a coordinated, orchestrated effort to inflict economic pain, deliberately slowing demand for Chinese goods at home as well as in Europe and elsewhere. Keeping the dollar strong by hiking up U.S. interest rates has successfully reduced demand for Chinese manufacturing and also driven up the cost of inputs such as energy and food. It has also indirectly weakened the yuan. Driving up the costs of imported materials has made Chinese products more expensive, so they are unable to compete with the likes of Vietnam, India, and Mexico. There's no evidence yet that this has weakened the CCP's grip on power, but if things continue on the current trajectory, that could change. Let's now take a look at what effect the strong dollar has had on Russia. So far, Putin's position remains unchallenged, and Russia's economy has proven to be remarkably resilient. However, cracks are starting to show. Sanctions have weakened the ruble and made the process of exporting oil and gas increasingly troublesome. By pouring cold water onto China's economy, as previously outlined, it has resulted in falling demand for fossil fuels, thereby hampering Russia's ability to continue funding their war of attrition in Ukraine. Moreover, Russia's shift to a wartime economy has diverted resources and skilled labor away from activities that would typically contribute to GDP growth. The focus on producing weapons of destruction, which are ultimately designed to be deployed and likely destroyed on the battlefield, don't generate lasting economic value, and this will inflict irreparable harm to the nation in years to come. Don't forget, it was the arms race with America that bankrupted the Soviet Union and put an end to the Cold War. Additionally, citizens are facing reduced personal freedoms and declining living standards, which are likely to worsen as tax rises will be needed to fund the war effort as income from energy exports starts to wane. This could lead to civil unrest, potentially forcing the government to prioritize quelling domestic dissent over pursuing external military ambitions, though there's no indication that this is likely to happen anytime soon, if at all. Economic hardship not only impacts the general population but also military personnel. Soldiers and officers facing financial difficulties at home may experience low morale. This is particularly the case in China, where the one-child policy means that young men are regarded as very precious, as they are often their family's only source of income as sole breadwinners. Further evidence that this is a global coordinated effort is the sudden, unexpected, and seemingly nonsensical act by the Bank of Japan to raise interest rates. This took everyone by surprise because on the face of it, this is a completely illogical thing for the BOJ to do. However, if you put it in the context of the swarming defense hypothesis, it makes sense. This move was primarily aimed at placing economic pressure on Beijing by strengthening the yen, thereby further weakening the yuan and making Japanese products that China needs to import more expensive. While this strategy will continue to hurt the Japanese economy and negatively impact the Japanese stock market, which fell by around 20% in 3 days but has since recovered, it will provide the yen with some protection against the explosive force of the world's reserve currency, which is clearly being used as a strategic weapon. Think of it as friendly fire between two allied nations. It's impossible to know if there is an implicit, by which I mean unspoken, understanding, or it is based on a formal pre-agreed arrangement between Washington and Tokyo. That's why this is a hypothesis and nothing more. So what if I'm right? If there is a concerted effort to keep interest rates higher for longer, it will lead to a hard landing and a global recession starting as soon as Q1 next year. However, if this strategy succeeds in averting a hot war, then in my view, that would be a price worth paying. World peace, mission accomplished. For investors, understanding the implications may offer insights into where assets should be best allocated. If interest rates are likely to persist, safe havens like US T-bills, commodities such as precious metals, and sectors less sensitive to interest rate fluctuations might offer more stability. Meanwhile, exposure to Chinese markets may become increasingly risky, so look for alternatives. Perhaps consider investing in nations that are likely to benefit from China's downfall, like India, Mexico, Vietnam, and Thailand. So let's return to what I think will happen with U.S. interest rates over the coming weeks and months. According to reports, traders are signaling a roughly 60% likelihood of an emergency 0.25 percentage point cut within 1 week from the 5th of August. But at the time of making this video, prediction markets don't agree. According to Manifold, the chance that the Fed will raise rates at their September meeting has jumped significantly since last week. As stated, I agree with the consensus. However, I don't think they will cut rates by more than 25 basis points. That's because the swarming defense hypothesis suggests that the Fed is not just reacting to domestic economic signals, but is playing a crucial role in a coordinated effort among Western and other allied nations to weaken the economies of strategic foes. However, I don't think they'll want to go too far and cause a depression, which is why I predict a modest cut in September of 25 basis points. This would be a pragmatic move that will act as a pressure valve to release some of the growing economic strain, but keep the US dollar sufficiently strong. This is clearly an antithetical view, as even Fed fund futures are predicting a 75 basis point cut, so I'm really going out on a limb here.
Fed fund futures are now all in, not just for a 25 basis point cut in September, not just a 50 basis point cut in September, but there is now a significant percentage odds that we will see a 75 basis point cut.
Instead of gifting markets what they really want in the form of a rapid series of rate cuts before Christmas, I predict the Fed and U.S. Treasury will use every tool available to them to quietly prop up the economy in order to keep markets relatively sanguine until after the election. In terms of monetary policy, expect further strategic communication from Jerome Powell as he continues to use forward guidance to manage market expectations and influence investor behavior without making immediate changes to monetary policy. Also expect yield curve controls to subtly inject liquidity into the banking system to help stabilize asset prices without signaling a shift in direction. On the fiscal side, the U.S. Treasury will continue to inject liquidity into the system via a series of buybacks. According to the latest tentative schedule, the program will start with an $8.5 billion buyback in August, followed by $31.5 billion worth of treasuries in September. Thereafter, the U.S. government will initiate a further $10 billion worth of buybacks in October. This is in addition to the hundreds of billions already set aside to fund the Inflation Reduction Act, which aims to bolster the U.S. economy while keeping the dollar strong. Investments in clean energy, electric vehicle production, and domestic semiconductor manufacturing will reduce reliance on Chinese imports by onshoring critical industries. If there's a kinetic war with China over Taiwan, this will make the U.S. economy less vulnerable to global supply chain disruptions. In conclusion, the swarming defense hypothesis suggests that the U.S. and its allies are engaging in a calculated strategy to tolerate a strong dollar in order to wage economic warfare against China, as well as nations that the People's Liberation Army will need to depend on for resources, military support, and logistics. In the event that war were to break out, I have mixed feelings about whether an economic coalition of this nature truly exists. On one hand, it seems to contradict the principles of free markets and what capitalism is supposed to represent. However, there's a certain reassurance in the idea that a strategic plan is being implemented with the potential to prevent a military conflict that could spread beyond Asia. It's comforting to think that these actions might be aimed at ensuring a more stable and peaceful future. As previously stated, this is purely a hypothesis dreamed up by me in order to stimulate debate. Nothing more. If this analysis resonates with you, please like, subscribe, and share your thoughts in the comments. Do you agree with my hypothesis? How do you think it will impact global dynamics in the coming years? Are we looking at a hard landing and a global recession next year, or am I being too cynical? If so, what do you plan to do to protect your investments? I look forward to hearing your thoughts and insights. Thanks for watching. Disclaimer: this content is intended for entertainment purposes only. We do not guarantee the accuracy or completeness of the information provided. We are not responsible for any losses or damages that may arise. Nothing should be interpreted as investment or financial advice.